Good afternoon, everybody. I'm Dan Hussey with Zaner MarketCast here to give you an update for our agricultural markets. We're going to be doing a little bit of a different format here, getting a little more technical, diving down into some charts. My partner in crime, Joe Nacrudo, couldn't be here today. But with that being said, let's just jump right into it. The typical format here, folks, that I do is, we'll go over some charts, mainly start with some daily charts. Kind of break down what we're seeing on the daily and the weekly time frame, and then even drive down a little further here into some smaller sub time frame charts, maybe talk about some spreads. But before we get into anything, let's update us with a little bit of our news today. Thanks to Karen Braun from Reuters here, publishing this great breakdown of U.S. net export sales for the week, I should say. Unfortunately, just abysmal sales and actually marketing year lows for wheat and beans here today. 141,000 metric tons of wheat sold, way below trade estimates, bringing year-to-date totals to 16.9 million metric tons. But again, that's only 11% of the year-to-date total compared to last year. Corn, again, below trade estimates, not a marketing year low, with 770,000 metric tons for delivery for the 24-25 marketing year, bringing us to 38.8 million metric tons. And, that's 30% of our USDA forecast. Beans, a marketing year low. You can chalk these numbers up to, of course, being holiday markets and thinly traded business plans, but 485,000 metric tons there, only 11% of our year-to-date totals at 40 million metric tons sold. Soy meal, 204, kind of right in the middle of expectations there. And soy oil, 38, beating trade estimates. So seeing larger amounts of bean meal and oil being sold this year, not something we traditionally see, as many of our export partners that take soy complex products prefer to do the crushing themselves to get that value add on their balance sheets rather than giving that business right to U.S. or South American crushers. All right, let's begin today with... Let's just begin with corn, because I do think while corn closed down 8 3/4 cents on the day here for March corn, we were able to hold up pretty well on the weekly chart. It looks like we closed only down about 4 cents week over week, but certainly well off of their highs here for a weekly close, and right back into, you can see that old high from December, as well as the old highs here from October and into September there on the corn March weekly chart. Kind of getting rejected at that downward sloping trend line in it looks like the 55-week moving average as well. And then, if you're big into math, that 50-week moving average is not so far off from your 200-day moving average, which in this case actually held up as support here at 448 and the lows of today. You got that 18-day red moving average here coming in as support as well. 55 days still well below us at 437 3/4 or 1/4, with the 100-day even below that, and now kind of aligning with that upward sloping trend line that held against the lows since August on this chart. Again, we are back above those old highs, from October and November respectively, but we did get rejected up around that 460 area, which is that old contract low that we began this year off with in February that we took out in the summer months, slid below, and it's hard to call this anything but consolidation now below that point. But again, this chart gets very bullish again above 460, above that downward sloping trend line on the daily chart, as well as after holding the 200-day and 18-day moving averages, kind of breaking above, now back and filling to hold that area as support. Let's take a look at the smaller time frame for corn. Look at the March corn chart, 4-hour chart now. A lot of the same levels on it. The dots that you see, or the lines, the red and blue, represent the monthly highs and lows. The purple and magenta, or the cyan and magenta, I should say, represent the highs and lows for a daily candle. Outside day lower to start us off here for the second day, full trading day of the new year. Not a good look. Closing below that range low at 450, or going below, I should say, but closing back in kind of gives you a little bit of hope that this could have all been a pullback into support. And if we clamber back above, 454 and certainly towards 459 and above, this market just looks like it had, one took a step back to test old resistance, now as support. You got to worry a little bit if we slip below that 450 area, because it's going below the 200-day, the 18-day moving average, getting below the old range highs. And this does then look a lot like a head fake, and maybe a lot more like wheat or beans are looking recently, which we'll take a look at here in a minute. But back below, the lows of today, corn, next support to the downside really doesn't come into me. Come into the charts for me until around 440. But even then, this upward sloping trend line at 435 could be the next place to find that support. Below there, you're back into your old range. Contract lows around $4 maybe come within striking point. And it doesn't sit well for the bulls that this entire rally was just up into this 50% retracement of the old swing from 509 highs down to 403 lows. So if we do take out contract lows, downward targets towards 380 could be in play, but we don't need to talk about that just yet. This is still some lightly constructive price action. I still see this as the market having broken above some technicals, testing with support, and into Monday's price action, we might have a clearer picture for the corn. Let's move on forward. Let's take a look at soybeans here. March soybeans, I'm not paying too much attention to Jan, but a similar idea here. The March beans had a little bit of a head fake here, only spending a day and a half above that old broken trend line that you can see here on the chart, began from way back in March of 2024. Held again in September of 24, held again in November of 24. We then, of course, went down and capitulated and came back up to break above it, only staying there for about a day. The 55-day moving average was holding a support, as well as the downward sloping trend line around that 1002 figure from yesterday's trade. The 100-day moving average at 1020 seems to be some form of resistance for the time being. And I also want to point out, we have not been above 1020 in March soybeans since October 14th or 15th. And you can see here, with the exception of 1, 2, 3 days, these are the only days right here in what was effectively like a little head and shoulders pattern, in my opinion. We have not been above that 1027 to 1020 area since basically mid-October. We came back up there to test it yet again, got rejected, and now we're back down into that old range that we were in before we capitulated to the contract lows. We're still holding above our prior contract lows, which is kind of a good sign, so to speak, and held that 18-day moving average. You can see here at 991 as support today. But you slip below today's low, and now you've taken out last week's lows and are unwinding the entire rally that we had from contract lows, which is not a good sign. After a failed breakout attempt at that trend line, the 55-day moving average failure to get above the 100-day, and now we are no longer overbought in our RSI. So could be a signal for a top, but some volume comes in here and we take it back up the other way. This market gets pretty bullish back above $10 and certainly back above 10.15 and around the highs of today. That's what opens the door for, talking 10.50 prior highs from November and even, $11 highs from September. But we get below today's low, below that 18-day moving average, below the old contract lows. The market has already proven to you that between 980 and 940, there's nobody home. Volume was a little bit of declining today, but it has been, the start of a new year. So we'll see. Volume was declining the last 2 days of in the rally. Volume declining on this pullback just means that I think that a lot of the longs that bought this market up are still holding. And if we slip any lower, that's when we'll probably start to see the panic selling. So I am very worried here that this was a bit of a fake out, and bean markets could be coming under pressure. I also want to point out that over these last couple months, we have seen some bear spreading on green days and bull spreading on red days. Basically, we ran up to, in our March, July spread here, we ran up in highs to 18 cents under, hit that 18-day moving average. I mean, they were bull spreading here on the way down for beans and then started bear spreading on the way back up. Today was the first day where I don't want to say they weren't bull spreading because it was a green day, but they were unable to really, really make progress with it now that we're below all the spaghetti trails of our moving averages. There's still a bit of a trend line on the lows, and you could call this a bit of a bear flag. I'm not exceedingly bullish on this. I think, it makes sense to me to see this continue to unwind, and particularly when we look at the old crop, new crop, July-November spread. And again, let's take a look at how far down this thing can go to full carry real quick, which I already generally know that it can get to, $1 or under, but 80% of that's going to be about 85 to 90 cents. $1.15 under is full carry on this spread, and we are currently inverted. Last year, this is so reminiscent of last year. In fact, last year we were like even more wildly inverted at this point in the year. They were like up in the 50 cents over range. This market has been unable now in the recent rallies to take out some of those prior levels that we've traveled below 25 cents over. 17 to 18 cents over, got above it there a bit, but it's been capped. We've been really consolidating sideways. And now, the market, for whatever reason, is staying inverted at a time when I don't see the justifiable narrative for a shortage in soybean supplies that would demand consumer or commercial needs now to keep this thing inverted. So if there's going to be a carry trade to capture again, as we start to bear spread this lower, take out these lows, get under, go back to even money and start going under. Building that carry back into this market means that this spread has the ability to trade, 80 cents lower from here, and until it gets to that cash and carry levels of about 80 to 70 to 80% full carry, and that's something that decisively last year kind of occurred into plantings as we start to sober up on the idea that we'll be planting soybeans again. There's another crop coming down the pipeline, and the market starts to prepare for that inevitable windfall of grain. And without some kind of act of God or weather event to add that fear index back in that there isn't going to be grain for the future and we need it now, the logical and economical, textbook, dynamic says that, hey, this market and this spread could very likely continue lower. And the bear spreading that we've seen going on in the old crop, new crop bean spreads was not indicative of the rally we saw at all in the outright futures, right? From the time we made a contract low in the beans and rallied, they've been bear spreading July Nova beans. And that's not a great sign for the long-term trend. In our wheat markets, we've got another down day. Wheat, Chicago wheat here. I mean, if there's any indication of what the bean chart could do, right? Wheat went down, capitulated, came back up, held that trend line again, and then, got smoked down to new lows here. So this is not so different of a look to our wheat chart, our bean chart. We were overbought conditions. We've unwinded that. Now we're heading down. We'll probably be oversold by Monday in our daily RSI. Increasing volume here, folks, on the March wheat. So not a good look if you were hoping that the prior contract lows there were going to mean something. And finding that 18-day moving average basically as resistance as we only spent a day or two above it and then got smoked below seems very reminiscent of the last time we tried to get above that 18-day, failed, and held that downward sloping trend line yet again. In the shorter time frame, however, 50% retracement from the 570 highs to the lows here, 61.8 to 50% area were held as resistance. Downward targets 520 and 504, from that swing, are projected downside targets at this point. You've also got, a bit of a channel, I guess you could say, running lower here for the wheat, where, okay, we could be coming close around that 520 area, around that downward, channel support area. But generally speaking, right, wheat was holding this upward sloping trend line, constructive higher highs and higher lows, failed at some daily technical indicators, came down, failed this trend line, and just flushed out. Any longs in this market just panic sold, it seems like. And I would not be surprised to see that commitment of traders this week really swing towards the short side after today's price move. It's KC wheat and Minneapolis spring wheat, just to give them a little bit of love and quick look today. No new contract low there from KC wheat. A little choppier here down. Not as convinced it wants to go lower as the Chicago wheat is, but I feel it's going to be dragged to probably a new contract low here as well, closing at 539 on the day, down 12 3/4, with Minneapolis spring wheat making a new contract low, having its finally having its kind of capitulating moment as it was holding up for the most of November, unable to break back above that 18-day moving average, and flushed out here with some increasing volume, down 11 3/4 cents. So I think wheat is trying to hunt out that next and new low. We're probably closing in on it based off of wheat complex, how we're seeing that play out across the board. So We'll see here. I know not a lot of great news to report, but we got to talk about price action for what we're seeing rather than what we think. Well, that about wraps it up. You can always get in contact with me over here at Zaner Ag Hedge at 312-801-4231. That's 312-801-4231. You can find me on X at Daniel Hussey Jr., Dan SOTD on Facebook, or shoot me an email at dhussey@zaner.com. Leave a like, a comment below. Sign up to be a part of our daily call-in, or shoot us a question for next week's market strategy, or MarketCast. And until next time, everybody, I'm Dan Hussey with Zaner Ag Hedge, and we'll be back with you as price action develops. Take care, everyone.